Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors. September 20th, just after the close. For a benign index week, the S&P only off 0.5%, the Dow off 1%. Heck of a lot of news going on. Interesting to see how the markets digested this news. Let's start with fixed income. We had headlines throughout the week about the Fed having to inject liquidity into the repo market. What does that mean? What is the effect on the credit markets? We know what it means from a liquidity situation in the banks lending to each other and securities firms lending out treasuries. We don't have time to go into all that detail right now. But anytime we see any kind of liquidity problem, we're on our toes. We know in the fixed income markets, two things can really hurt us. That's credit problems and liquidity problems. So we're doing and continue to do a lot of work there. When we're analyzing the markets, such as that credit market, we like to look at cross-market indicators, as I mentioned earlier. The fact that junk traded with a strong bid through the week gives us a thought that this liquidity issue in the repo market may not be an overreaching scenario. We know, you know, as investors in any kind of market, be it equity or fixed income, if the junk markets start to crack, that's a telltale sign that there's trouble. There's liquidity trouble, there's credit trouble. JNK, which is an ETF, a basket of junk bonds, traded firm throughout the week and went out just about at highs today. So that's something we'll keep an eye on. In terms of energy, don't forget, after last Friday's video, the Saudi oil complex came under attack. Markets had to spend the weekend digesting that news. We saw Monday a big, starting Sunday night in the futures market. As a matter of fact, in that thin market, late in the 6 p.m. Sunday when the energy futures started trading, you saw energy up 16, 17%. That was short-lived. Monday, the commodity was up 10, 11, 12% throughout the day. Same with equity, especially the servicers and drillers, the explorers. They gave back about half throughout the week. So that market calmed down. Some edge came off that market. We can't go to sleep on that market though. That attack is a two-pronged scenario. Number one, it knocks out some supply. How quick that supply comes on, that's a matter of debate. Number two, it roils that Mideast tension that seems to never go away. And that can always have an effect on the energy markets. We are in a much better scenario domestically with what's gone on in natural gas over the last 10 years. We're very well supplied. This is a very different situation supply-wise than 25 and 30 years ago. So energy, if it can make a higher low in here, maybe has some legs. In terms of another cross-market scenario that we like to watch, the Fed this week cuts the Fed funds rate 25 basis points. Right into that cut, interest rate sensitive equities rally. How can that be? That's something that we normally don't see. Yet insurance companies rallied hard the afternoon of the cut. What does that tell us? Cross-market indicator, something that catches our attention. Maybe the markets feel that this cut is the final cut for a while, that both the markets can live with it and our economy can get enough out of this cut to continue a slow nudge expansion forward. And really, that's the best of both worlds. We don't want to see rates continue to drop. We've seen what low rates and negative rates have done overseas. It's hampered expansion, not helped. So maybe at a 172 on the 10-year, I don't know, maybe we can trade between 150 and 2.25 over the next 12 months. Have a happy medium, which would lend itself to some expansion. We'll report back next Friday on what we see. One thing's for sure, you know it'll be an interesting week in the capital markets. Have a great weekend.